We got economic indicators this morning, and I want to break down how this will affect the stock market. We got good news and bad news. First, good news. Inflation came in about as expected, and it is slightly lower. This is the PCE inflation index, which is the preferred inflation index for the Federal Reserve. This is the one the Fed actually pays attention to the most versus CPI. But the CPI comes in about 2 weeks before, so the stock market itself is going to look at that and say, well, we have a pretty good idea what the PCE is going to do. Therefore, PCE index moving in this morning didn't really affect the stock market too much, although the stock market did move slightly higher. But here's the bad news. The pace of expenditures by the consumer is slowing down. Inflation is putting a halt to consumption here in the United States by consumers, and that should continue forward, which is bad news for revenues for companies. Bottom line is personal consumption turns into income revenue for companies. And if the rate of pace of growth for personal expenditures starts to decline, so does revenues. So do, by extension, the prices of stocks on the stock market. Make sure to follow along. I break this down in my Substack. You're going to want to take a look at this. This economy is going to shift very rapidly, and you want to start paying attention. The stock market itself right now is at all-time highs, but I expect that to shift downward fast.